Hello everyone, welcome to Tesla Daily News. Today is June 14th, Saturday, and the following is the latest Tesla news. According to El Diario in Spain, Elon Musk now has a powerful new financial engine in SpaceX's record-breaking IPO, which is helping offset recent losses in Tesla's market value. Over roughly the past 6 months, Tesla's market capitalization has dropped by about $160 billion, falling from around $1.43 trillion in December 2025 to about $1.27 trillion now. For almost any other company, that would be a devastating destruction of shareholder wealth. For Musk, however, this decline coincides with a sharp re-rating of the broader Musk empire, led by SpaceX, which has just debuted on the stock market with an eye-watering valuation of more than $2 trillion. El Diario notes that Tesla's core auto business has clearly hit a speed bump. In 2025, net profit reportedly fell by about 46% to roughly $3.8 billion. Revenue from selling cars dropped around 10% to roughly $69.5 billion. Production declined about 7% and deliveries slipped roughly 9% to around 1.63 million vehicles. These figures show that, after years of seemingly unstoppable growth, Tesla is no longer the pure hyper-growth story it once was. The article highlights several reasons behind this slowdown. Competition from Chinese manufacturers, led by BYD, has intensified, with Chinese brands using aggressive pricing as a key weapon. That has forced Tesla to cut prices and sacrifice margins in order to defend market share. The disappearance of some tax incentives for electric vehicles in the United States has also taken a toll. In addition, Musk's controversial political alignment with Donald Trump and the broader fatigue around his public persona have dented Tesla's brand image among some consumers and investors. El Diario also points out a growing dependence on just 2 core models, the Model 3 and Model Y. Other products like the Cybertruck, the Semi, the Model S, and the Model X are contributing only a small fraction of total production and sales. While Tesla's energy business, including batteries and solar, is growing quickly, it still does not fully compensate for the cooling of the auto segment. For investors, this concentration risk means that any stumble in the demand or pricing power for Model 3 and Model Y has an outsized impact on Tesla's overall results. According to El Diario's analysis, Musk is actively trying to shift the narrative away from Tesla as a traditional car company and toward Tesla as a software, robotics, and artificial intelligence platform. At the beginning of the year, Tesla announced a $2 billion investment into XAI, Musk's separate artificial intelligence company created to compete with OpenAI and Anthropic. This was not just a financial transaction, but a signal of strategic intent. The message to markets is that Tesla should not be valued merely on near-term car sales and margins, but on its potential to become a leader in autonomy, AI-driven services, and robotics. Musk has gone so far as to say that the only vehicles Tesla plans to manufacture in the future will be autonomous, with the explicit exception of the Roadster. In other words, the car is envisioned less as a finished consumer product and more as a hardware platform for software, robotaxis, and data-driven recurring revenue. El Diario mentions Musk's heavy emphasis on projects such as the Cybercab robotaxi, designed without a steering wheel or pedals, and the Optimus humanoid robot, which Musk imagines working in factories and homes. The long-term idea is that Tesla's most valuable assets may not be its factories or even its current fleet, but its full self-driving software stack, its data, and the ability to deploy robots and autonomous vehicles at scale. The article underscores that this strategy remains risky. Wall Street has been hearing promises of imminent full self-driving for nearly a decade, with launch timelines repeatedly pushed back. There is still no mass-market, fully autonomous Tesla fleet operating on public roads under clear regulatory approval. Nonetheless, investors continue to grant Musk a generous benefit of the doubt. Part of the reason is that they see his projects as a continuum across the Musk ecosystem. Tesla, SpaceX, XAI, and other ventures all feed the perception that Musk can eventually turn ambitious technological visions into enormous cash flows. According to multiple international outlets, including the Manila Times, Kazinform, Reuters, The Straits Times, Reporter, GR, and others, SpaceX's historic Nasdaq debut is reshaping how markets view Musk's overall empire and, by extension, Tesla's relative role within it. SpaceX shares, trading under the ticker SPCX, were priced at $135 per share and opened at around $150, then climbed to close near $160.95, up roughly 19 to 22% on the first day depending on the report. Based on that closing price, SpaceX's market capitalization is about $2.1 to $2.2 trillion, instantly placing it as roughly the 6th most valuable public company in the world and making it more valuable than Tesla itself. This IPO raised about $75 billion in gross proceeds, surpassing Saudi Aramco's 2019 listing as the largest IPO in history. SpaceX alone now represents roughly 3% of the entire U.S. stock market's value, according to Greek outlet reporter GR, citing FactSet and Dow Jones market data. According to these reports, this valuation jump has made Elon Musk the world's first trillionaire on paper. Estimates suggest his net worth is now around $1.1 trillion, with roughly $690 billion tied to his stake in SpaceX at IPO pricing and about $279 billion tied to his holdings in Tesla. For Tesla enthusiasts and shareholders, this shift means that Musk's personal financial fortunes are no longer tightly coupled only to Tesla's share price. Weakness in Tesla can, at least in the short term, be cushioned by strength in SpaceX. The Manila Times and other outlets explain why SpaceX went public at this moment. Musk has said SpaceX needs massive amounts of capital to fund satellite constellations, orbital data centers, and ultimately its ambitions to build a human colony on Mars. After acquiring xAI, which is reportedly burning around $1 billion a month on computing infrastructure and AI model training, the cash demand has grown dramatically. The IPO proceeds will also help finance the expansion of AI computing capacity, Starlink's satellite network, launch infrastructure, and next-generation rockets like Starship. For Tesla investors, the key question is how this new capital and the integration with xAI might indirectly benefit Tesla. One possibility is that advances in AI infrastructure and model training at SpaceX and xAI could spill over into Tesla's autonomy stack and robotics, especially if Tesla and xAI share technologies or datasets. Another possibility is that Musk's time and focus become even more stretched, potentially distracting him from Tesla at a delicate moment in its competitive cycle. Governance concerns are heightened by the fact that Musk now controls about 82% of the voting power in SpaceX through special super voting shares, despite owning roughly half of the economic interest. This mirrors similar control dynamics at Tesla, where shareholders have already challenged the scale of his compensation and his influence on corporate decisions. According to Reuters and other financial outlets, Tesla's stock actually slipped around 2% on the day of SpaceX's debut, even as major U.S. indices like the S&P 500 and the Dow posted gains, partly lifted by enthusiasm over the SpaceX IPO and geopolitical optimism. That divergence suggests some investors might have been rotating out of Tesla into SpaceX to gain exposure to Musk's vision via what they now see as the more exciting or higher upside vehicle. Market strategists quoted by Reuters noted that the SpaceX IPO was being watched not just as a one-off listing, but as a test of whether markets could absorb a massive supply of AI and space-linked shares without destabilizing other high-valuation names. Some analysts linked recent weakness in tech stocks and even Bitcoin's declines to investors trimming risk positions ahead of the SpaceX offering. Now that SpaceX is publicly traded and quickly being added to major indices, index funds and ETFs will be compelled to buy its shares, partially at the expense of allocations to other megacaps, potentially including Tesla. According to Indian outlet Limit, retail investors flocked to SpaceX shares in extraordinary numbers. The company allocated a record high portion of the IPO to individual investors, with some reports speaking of allocations around 30% of the shares for retail. Platforms like SoFi described it as the largest and most oversubscribed offering on their platform. Net retail buying of SpaceX accounted for about 4% of all single-stock retail turnover on the first trading day, surpassing even tech favorites like Nvidia. For Tesla followers, this enthusiasm is highly relevant. Musk had previously promised that if any of his still private companies went public, he would prioritize retail, especially loyal Tesla shareholders. That idea of loyalty deserves loyalty appears to have been at least partially honored in the SpaceX IPO structure. Some Tesla retail investors used this opportunity to diversify within the Musk ecosystem, buying SpaceX shares while continuing to hold Tesla. Others, frustrated by limited allocations, reported receiving far fewer shares than requested but still expressed excitement simply to be involved. This massive retail participation reinforces the notion that Musk commands a unique fan investor base that is willing to commit capital across his ventures, not just Tesla. It also helps explain why markets sometimes award very high valuations to his companies despite financial metrics that might not justify them by traditional standards. That same enthusiasm can, however, cut both ways. If sentiment were to turn, it could simultaneously affect Tesla, SpaceX, and xAI, given the overlap in their investor bases and the central role of Musk's personal brand. According to multiple outlets, including the Straits Times and the Manila Times, there is also growing skepticism among more conservative analysts about the extreme valuations now attached to Musk's companies. Morningstar, for instance, has argued that SpaceX is significantly overvalued at current prices, estimating its intrinsic value at roughly $780 billion, less than half its present market cap. They point to daunting technology challenges, such as shielding orbital data centers from radiation and catching up with AI leaders like Anthropic and OpenAI. For Tesla investors, such skepticism is familiar. Tesla itself has long traded at valuations far above traditional auto industry multiples, supported by expectations of future software and AI revenue. Now, however, some of that future promise premium appears to be migrating towards SpaceX and xAI. Nobel Prize-winning economist Paul Krugman, cited by El Diario, has gone so far as to compare Musk's empire to a pyramid-like structure that continually needs fresh capital and new narratives to sustain high valuations. He warns that many of Musk's grandest promises, from Hyperloop systems to large-scale boring company tunnels and true full self-driving, remain either unfulfilled or very limited in real-world deployment. Krugman argues that a large part of Musk's wealth rests on a self-reinforcing circle of expectations. Investors buy because they believe in his business genius. Rising share prices then reinforce the perception that he is an infallible visionary, which leads more investors to buy. In this view, the valuation of SpaceX is another example of markets rewarding long-term stories far more than present-day fundamentals. This critique is highly relevant to Tesla shareholders. The company has delivered real, transformative achievements: mass-market electric vehicles, industry-leading battery technology, a global charging network, and substantial stock returns over the past decade. Yet some of the most ambitious Tesla narratives, like millions of robotaxis driving autonomously in city centers, remain in the future. With SpaceX now public and xAI consuming enormous resources, investors must decide how much of Tesla's valuation is based on current earnings power versus long-dated, still uncertain projects in AI, autonomy, and robotics. At the same time, Tesla's earlier stock market performance shows how rapidly sentiment can swing. Since its IPO in 2010, Tesla has returned roughly 20,000% to shareholders, creating over $1.2 trillion in investor wealth. That track record is part of why markets are willing to take a leap of faith again, first with SpaceX and potentially with future listings like OpenAI and Anthropic. But it is also a reminder that even spectacular winners can go through brutal drawdowns, as Tesla's latest 6-month slide illustrates. For Tesla enthusiasts, the key takeaways from this week are that Tesla is no longer the only or even the main driver of Musk's net worth, that the Musk universe of companies is now even more tightly interlinked by AI, data, and capital flows, and that the market's belief in long-term technological disruption continues to overshadow near-term profitability concerns. Investors must weigh the upside of being aligned with Musk's sweeping vision against the risks of execution delays, governance issues, political controversies, and the very real competition now emerging in both EVs and AI. Thank you for listening to Tesla Daily News. If you found this episode helpful, please subscribe and stay tuned for our next update.